Welcome back to the Deep Dive. Today we are taking on, well, one of the most electrifying and frankly terrifying markets out there.
Cryptocurrency.
Exactly. For years, investors poured their capital into physical assets. Gold, real estate, things you could touch.
Tangible things.
Right. And now, so many of those same people are making the leap into digital investments, specifically crypto coins.
And it's an investment shift that is just defined by, well, by inherent chaos.
Chaos is the right word.
I mean, unlike traditional assets, these digital coins are subject to really intense, often unpredictable volatility.
We're talking about fluctuations that can lead to absolutely massive losses, seemingly overnight.
The uncertainty is the real enemy here.
It is. And that high-risk profile makes forecasting not just, helpful, but absolutely essential for anyone trying to navigate this landscape.
If you can't eliminate the uncertainty, you have to at least try to measure it. Predict it with as much accuracy as possible.
And that's our mission today. We are unpacking a study that was designed to do just that, to try and tame the chaos.
Right. Researchers rigorously compared three powerhouse predictive algorithms: long short-term memory, support vector machine, and polynomial regression.
All to figure out which one is the most reliable choice for predicting crypto prices.
And before we get into the nuts and bolts, we have to talk about how we're keeping score.
Yes, the scorecard. For this entire deep dive, we are tracking one single crucial metric.
That's the mean square error, or MSE.
MSE. This is really the gold standard for this kind of comparison, isn't it?
It is. The MSE just measures the average squared difference between the model's prediction and the actual price.
So it basically tells you how far off the guess was.
Exactly. So the takeaway for you is simple. The lower the MSE value, the better the prediction. It's that straightforward.
Okay, let's unpack this toolbox.
Yeah.
When you're dealing with something as wild as Bitcoin prices, why these three algorithms specifically?
Well, they represent a fantastic cross-section of modern predictive analytics. You've got deep learning, classification, and enhanced statistics.
A little bit of everything.
Right. The extreme uncertainty of crypto really requires robust models, and these three just offer different strengths for this kind of complex data.
Let's start with the one most people probably associate with this kind of thing, the deep learning specialist.
That would be the long short-term memory, or LSTM. It's a pretty sophisticated type of artificial neural network. Its main feature is its memory cell. So unlike simpler networks that forget things pretty quickly, the LSTM can actually retain information over really long periods.
So if Bitcoin's price today depends on a trend from 6 months ago, not just yesterday, an LSTM can actually remember that context.
Precisely. That memory is why it's considered so suitable for analyzing time series data, where the sequence and the history really, really matter.
Okay, next up is the support vector machine, or SVM. I usually think of this for classification, like, is an email spam or not spam?
It's a classic use, yeah. But it's incredibly powerful in regression, too.
Yes.
It's so versatile.
So how does it handle price prediction?
In its simplest form, it finds the best hyperplane. So imagine you have a bunch of data points, some are buy and some are sell.
Okay.
The hyperplane is the ideal line or boundary that separates those two categories with the biggest possible margin. It makes very clear distinctions.
But price data isn't a straight line. It's all curves.
Right, and that's where it gets clever. SVM uses what are called kernel methods to basically take that messy, nonlinear data and project it into a higher dimension where it suddenly can be separated by a straight line.
Wow. Okay, so it finds a way to make it simple.
It's a very sophisticated way to handle nonlinear problems. A real contender.
Got it. And that brings us to the third one, polynomial regression. This one sounds more like a classic statistical workhorse.
It is, but it's an upgraded one. It's an extension of standard linear regression.
Which just draws a straight line.
Right. Polynomial regression lets you draw curves. It uses a degree parameter, so the model can create these complex, curvy lines to fit and predict nonlinear patterns.
Which you absolutely need for chaotic crypto prices.
You do.
So we have the memory expert with LSTM, the adaptable classifier with SVM, and the sophisticated curve fitter with PR.
Yeah.
A powerful lineup.
It is.
Let's talk about the data they actually fed these systems.
They focused exclusively on Bitcoin, the biggest and most established coin. The data set covered a really significant 4-year period.
Which was?
2020 through 2024. And this period is so critical because it had everything. Massive bull runs, intense crash cycles.
It's the ultimate stress test.
Exactly. It gave the models the maximum amount of volatility to learn from.
And they sourced all this from Yahoo Finance, focusing on the detailed closing price for each day. What did the data prep look like?
It was standard, but very rigorous. They did normalization first to get rid of any null values and make sure everything was weighted equally.
Okay.
Then they allocated the data, the traditional 80-20 split.
Yeah.
So 80% of that 4 years of data was used to train the models.
Letting them learn the historical patterns?
And the other 20% was held back purely for testing them against data they had never seen before.
This is where it gets really deep, though. The tuning. You can't just feed the data in. You have to customize how the model learns. Let's start with LSTM.
Right, so for LSTM, they focused on epochs. An epoch is just one full cycle where the entire data set is passed through the neural network.
Forward and backward.
Exactly. They used something called the atom optimizer, and then they iterated the training with different numbers of epochs, 10, 30, 50, 80, and 100.
So they were basically asking, how many times does the model need to see the history before it gets it right?
That's a great way to put it.
And for polynomial regression, that tuning sounds simpler. It's all about the degree.
It is. For PR, they tuned the degree parameter, testing 2, 4, 6, 9, and 11. If degree 1 is a straight line, degree 11 is, an extremely complex winding curve.
And the risk there is overfitting, right?
Absolutely. They needed to find that sweet spot that captured the complexity without just memorizing the past, which would make it useless for predicting the future.
Okay, now for SVM. You said this one has the most knobs to twist. They use something called grid search CV.
They did, which is basically just a systematic way to brute force test every possible combination of parameters to find the best one.
And what were those parameters?
Well, they tested 3 core kernel types: radial base function, or RBF, sigmoid, and linear.
So really complex curvy boundaries versus a straight one.
Exactly. RBF and sigmoid are for highly nonlinear patterns, while the linear kernel, well, it does what the name says.
Find straight boundaries.
They paired those with the regularization parameter C. This basically controls how much you penalize the model for making a mistake.
Okay.
They tested C values from 1S up to 1E3, and for you listening, 1E3 is just 1,000. A high C value forces the model to be really, really accurate.
So it prioritizes accuracy over finding a smoother, more general fit.
That's right. And then finally, the gamma coefficient. Gamma just controls how much influence a single data point has. They tested a few of those as well. They were really hunting for that perfect combination.
That is an incredibly thorough setup, which sets the stage perfectly for the main event, the results. And remember, we are looking for the lowest mean square error.
Let's start with polynomial regression, the statistical classic.
What was its best performance?
The lowest MSE for PR was achieved at degree 6. The resulting error was 51,702,001.51.
Whoa, wait, 51 million.
51 million, yes. It's a colossal error.
I mean, to put that in perspective for everyone, if Bitcoin is trading at, say, $50,000 and your model has an average squared error of 51 million.
Your prediction is effectively useless. You're likely off by tens of thousands of dollars.
It just shows how hard it is to apply a generalized statistical approach to this level of market chaos.
It does. And what's fascinating is that the highest error was at degree 11. When they tried to make the curve too complex to overfit it, the predictions actually got worse.
Okay, so PR crashed and burned. Let's move to the deep learning contender, LSTM. This one was built for this kind of data.
And it showed a massive improvement. It really leveraged that memory capacity. They found the sweet spot was 30 epochs.
And what was the MSE?
The lowest MSE for LSTM was 97.91507.
Okay, so 97.92.
Yep.
That is a jaw-dropping leap from 51 million. I mean, it's not even in the same universe.
Not at all. LSTM did a far superior job understanding the sequential, time-dependent nature of the price data. This is what we'd expect, really.
Right.
It learned the patterns in about 30 full passes. But interestingly, going beyond that didn't really help. More epochs didn't mean a better result.
So the deep learning champion sets the bar high at 97.92. That's really impressive. Now let's see if the hypertuned SVM could even get close to that.
And this is where the results just came.
Yeah.
They completely defied conventional wisdom.
How so?
They tested all those combinations, right?
Cool.
Complex kernels, RBF and sigmoid, versus the simple one.
The linear kernel.
And across the board, the linear kernel consistently produced the smallest errors.
So the straight line approach actually worked better than trying to draw complex curves through the data. For volatile crypto, that seems totally counterintuitive.
It is, and it suggests something really profound about Bitcoin's price movements. But here's the knockout punch. the absolute lowest MSE value recorded by the SVM model.
Okay.
It was a startlingly low 0.02.
Stop. Wait. 0.02.
0.02.
Let me just process that. We went from 51 million with PR down to about 98 with the deep learning tool, and now you're telling me it's 0.02 with a classification algorithm.
It's an astonishing difference. It's 4 orders of magnitude better than the deep learning model.
How did it achieve that? What was the magic combination?
It was the linear kernel, combined with the highest regularization parameter they tested, C equal to 1E3 or 1000.
So high regularization was key, forcing it to find a really clean separation boundary. What about gamma?
And this is another interesting nuance. Once they hit that C of 1000 with the linear kernel, the error stayed at 0.02, no matter which gamma coefficient they used.
So the fine-tuning of influence didn't even matter at that point.
It became irrelevant. The success hinged almost entirely on forcing a highly accurate, clean, straight-line boundary. The linear kernel and high regularization, those were the keys.
That is the aha moment of this whole deep dive. Let's just run down the final tally, the best-case scenarios for each one.
Okay. Polynomial regression, tuned to degree 6, ended with an MSE over 51 million. Long short-term memory, at its best with 30 epochs, got a much, much better MSE of 97.92.
And the definitive winner?
The support vector machine model, using the linear kernel and that high regularization parameter, C, delivered an MSE of 0.02.
The conclusion seems rock solid then.
It is. Based on this data, the support vector machine algorithm, specifically with the linear kernel, is by far the most suitable for this kind of crypto price prediction.
I have to ask, though, why? Why did SVM, a classifier, dominate the tool that specializes in memory and sequence, like LSTM?
Well, it suggests that despite all the surface-level chaos, the underlying relationship between closing prices, day-to-day, might be more linearly separable than we assume, especially after data processing.
I see.
The SVM didn't need a complex memory, it just needed to find that one perfect straight margin that separated the underlying trend. And by forcing it to find that with high regularization, it filtered out all the market noise that might have actually confused the LSTM.
That is a critical insight. The trend might be cleaner than the raw data suggests. But the researchers themselves were quick to pump the brakes, even with this incredible result.
And that's vital context. This model performed exceptionally well in a controlled mathematical study, but they acknowledged a huge constraint.
Which is what?
Cryptocurrency prices are not solely driven by historical data. The market is constantly being hit by real-world events.
Right. Regulatory news, a tweet from the right person.
Exactly. External factors that the model has no way of seeing. A machine learning model sees the past, but it doesn't see a future regulatory ruling or, a social media frenzy.
So an external shock could overwhelm even an MSE of 0.02.
It could. If a news event causes a 10% flash crash, a model that only looked at past closing prices is going to be completely blindsided.
And that leads directly to their recommendation for future research. They know the models have to evolve.
They do. Their key suggestion was to start incorporating additional variables, specifically variables that capture sentiment analysis from individuals.
The human element.
The human element. They realized that the emotional drivers, fear, greed, that herd mentality, are what's currently missing from the purely mathematical equation.
So to recap this deep dive, we saw an astonishing result. A support vector machine, using a simple linear kernel and high regularization, dramatically outperformed both a classic statistical method and a deep learning star in predicting Bitcoin prices.
That 0.02 MSE is it's definitive proof of its capability in this specific context. A simple, strongly enforced boundary was the best tool.
But the research leaves us with that final provocative thought. It all comes back to the human element. The researchers called for integrating sentiment analysis. So this raises a question for you to think about. If a machine learning model like this SVM could perfectly map every historical price point and nail the math, could it ever truly predict the future without incorporating that unpredictable human emotional influence that drives panic buying and selling?
That's the real frontier.
It is, because understanding the crowd might just be the final missing piece of the prediction puzzle.